There's a lot of reasons why you could say that right now doesn't feel like 1999 and the dot-com boom and bust. But one reason you could potentially say it does is the fact that we do have all of these major tech companies coming public that are just hemorrhaging money right now. How do you think about it?
Well, Wall Street loves money-losing VC-backed tech companies. Of the 100-plus companies that have gone public, the $1 billion or more in the past 8 years or so, 64% of them were losing money. So it's just a continuation of the same trend. What's very different, though, from the dot-com era is that these companies, and Lyft is a good example, have substantial top-line revenues and a substantial growth. And I think that that's what's attracting people on Wall Street.
Which I think begs the question, Larry, as some of these companies go public, should investors, retail investors, for example, be investing in them?
Well, I think it's very, very dangerous for retail investors. You've created an environment here where there's a lot of attention. The supply of stock that's offered in these offerings is very, very small. 90 days later, there's the end of the lockup period and the supply increases. And generally when supply increases, given certain demand, prices fall. In addition, I think the market naively assumes ceteris paribus, that other things are equal. And if you take a couple of examples in the ride-sharing business that have happened in the last week or so, the first thing is that Logan Airport in Boston has put a surcharge on ride-sharing companies because they've been causing congestion at Logan Airport. And that's interesting because I spent 40 years in Boston and Logan Airport was recently remodeled, so it shouldn't be having congestion problems. The second thing here is that if you look at these companies, in order to hit profitability, they have revenue growth, sure, but they have to convert an inordinately high level of revenues to profitability. In other words, the costs have really got to disappear in order to make the earnings, or to make the earnings appear.
Right.
And at some point, Wall Street is going to want earnings. Wall Street has love affairs, but some of them are very temporary.
Eric,
so it's just a very, very edgy stew pot, if you will, right now.
Yeah, for me, it's not so much about the losses. I mean, we see companies going public with losses all the time. It's the trajectory that has me scratching my chin. Like when you look at Lyft and the amount of discounting and marketing that they're doing, both to attract drivers versus Uber and also to keep riders spinning around in their ecosystem. Once they go public, does that continue to be sustainable as they have to make some case that they're going to be profitable eventually?
No, they're probably going to have to tighten up their business model, and the subsidies, both to the drivers and in some cases to the riders, are going to have to be phased out over time. But let's also remember that Amazon, when they went public, there was a lot of doubt as to whether they could ever make money. And they, in fact, lost money for 7 years as a public company, and now they're nicely profitable, maybe on the basis of their cloud business. So these businesses always figure out a way. They always, with the right management, will pivot into a way that there will be a path to profitability.
Larry, I mean, you're no stranger to some technology names in your portfolio, the likes of Alphabet, for example, or Apple. Why wouldn't you have interest in having exposure to ride sharing, which by all accounts, regardless of surcharges or whatever it might be, is going to be perhaps a dominant form of transport in this world for some time?
I think if you look at the success of the companies in the Google, the Apple, at the end of the day, they deliver bits. And Lyft and Uber are software companies, but they deliver bits only with the assistance of human beings who preserve the service that makes the bit delivery profitable. So that Amazon now has been getting into some businesses where instead of delivering bits, it's using people to deliver bits, namely Whole Foods. And all of a sudden, some of the technology in the food delivery has been having a problem, and Amazon's richly valued, and maybe some people aren't going to like the value. It's 40 times EBITDA. So here you're dealing with a treacherous situation because there's a lot of humans, and humans are very, very hard to control. And these companies have already hit the viewpoint of the regulators. Uber brought in a new CEO because of regulatory problems. So you have the government, they're there. It's a treacherous field, David.
Eric, with all of these companies that are expected to go public this year, how would you be advising some of them as they come to the public market?
Well, as you would expect them to have a plan, and you would expect them to know what the next at least 2 or 3 quarters are going to look like. And yeah, you probably have to answer the question at some point as to when are you planning to be profitable. But I think that's, if they have a plan to sustain growth, and I think in the case of Lyft, it's very smart for them to go out first before Uber, because they'll probably soak up some investors who want to be participating in the category, but might not want to be in all of them. So they're probably taking some investors off the table. So that's a good strategy.
What about Casper, which your firm is invested in?
Well, there was a report today saying that they're looking for underwriters. Casper is a fantastic company. We were investors in them from the very beginning. They're category leaders, so it would be, to me, it would make sense for them to go public.